With that, and without further ado, let me welcome our first keynote speaker, Anna Pavlova, Professor of Finance at London Business School and Director of the AQR Asset Management Institute, recipient of many prestigious grants and awards, author of many publications in top academic journals, which have also been extensively covered in financial media, and rightly so, I think, because Anna obviously has a sense for timely, important topics, like the one she will talk about today, retail investors in the age of zero commission trading. So, ladies and gentlemen, please welcome Anna Pavlova.
Thank you very much, Michal, for this very kind introduction. And it is a real pleasure to be here and to talk to you all about this area that I find very exciting. Now, because of the Zoom participants, I think it's easier to have questions at the end. But if you have a burning question, and this is one of those topics in which so many of us have opinions, questions, remarks, then please jump in. Michal assured me that we can work around those as well. But so the main questions should be at the end.
Yeah, and I just add, if you are on Zoom and you have a question, you can signal that through the chat and we will get back to you after the talk.
All right, so it is not very common that you give a keynote on some topic and there are Hollywood movies on that topic. And this is one of those very rare occasions where there isn't even one movie, there is more than one. So Dumb Money, a recent movie about a GameStop episode where retail investors took on the Wall Street giants, with a roaring kitty at the vanguard. So that's one. And if you do not want like Hollywood actors, so there is a documentary on Netflix, Eat the Rich, again about GameStop and this interesting episode. What is this all about? Well, this is about the recent retail investor boom, the democratization of retail investing worldwide, which was led by the investing app Robinhood that pioneered this idea of zero commissions, which brought millions of new investors into financial markets. These investors are tech-savvy, young, yet they are novice investors, oftentimes first-time investors, especially in Robinhood. And that what distinguishes them from the traditional investors that we know. There are other distinguishing features that I will talk about as well. Now, how does a zero-commission brokerage make money? The traditional income of brokerages is from commissions. Well, most of the revenue of a brokerage like Robinhood comes from the so-called payment for order flow, or PFOF, which is the payment it receives from financial intermediaries for sending orders to them for execution. So these intermediaries are known as wholesalers or internalizers. And let me explain how this works in this little diagram. So this is a retail investor, a customer on Robinhood, and this investor sends an order on its smartphone to Robinhood for execution. Now, Robinhood decides, and in fact, it does it for the majority of the orders, sends this order to a wholesaler like Citadel for execution. In equities, a wholesaler can execute this order on its own private platform, away from national exchanges. This is known as internalization. And for the privilege to do so, it will send the retail broker a kickback, the payment for order flow, And it will also provide some price improvement for investors that we will come to. So it's clear what's in it for the retail broker. They receive payment for order flow from the wholesaler. What's in it for the wholesaler? And this is where information comes in to connect it to the theme of the conference. Retail order flow is the best order flow there is. It's balanced, symmetric, largely uninformed. So this is what the wholesaler would love to have sent to them. It just crosses the buys and the sells and pockets the spread. That's the idea. Let me put some research questions on the screen here. You might suggest more research questions in this rapidly developing area of research. First, about this payment for order flow practice. Is it good? Is it bad? Is it really bad? So you could already start thinking about the incentives this practice provides, these kickbacks, and so the incentive to maximize potentially this payment for order flow. How do you do it? By making investors trade more, or by nudging them into specific asset classes, right? Can we do that? Yes, of course. With the smartphones, there is a lot of nudging already going on. So we'll come back to that. So is that a good practice for to start with? Then the second question is whether retail investors benefit from execution by the wholesalers. And there is quite a bit of work already in this area. I will give you some evidence. There is also a question whether the rest of the market benefits from this order flow segmentation, because in my diagram, we effectively segmented the order flow. All the retail one goes to the wholesalers, and whatever is left, this highly information-driven, adverse selection problem prone, is there for the rest of the market to grapple with. Then another potential interesting direction for research is that now that these retail orders are routed to wholesalers, this helps us to potentially identify these retail orders in the data. So the traditional measures look at small orders, for example, if you want to classify which orders in the, let's say, transaction level data are retail. So now we have much better identification through by looking at the execution patterns of these wholesalers, and this will help us say more. So in addition to the data we have on retail orders from, let's say, individual brokerages, now we have this whole market data, which is a welcome addition to research, and I will talk about this. And finally, so this is where these new areas of research, and so far this has really been mainly market microstructure. There is a very tight connection of market microstructure to behavioral finance, because now that we know how to classify these orders, we can ask how this new generation of retail investors trade. Are they the same, for example, as the Barbara and Odin investors? And if not, in which ways are they different? And we can also revisit the old question as to whether they make money or lose money. You probably know the answer to that question. But there are some nuances in this recent data. So let's start with a payment for order flow. What do we know? So this is a controversial practice, because it potentially provides incentives to push investors to trade too much or to trade certain assets or certain asset classes. It is banned in the UK, in Canada, in Australia, but it's currently thriving in countries like Germany or the US. And so this is Ken Griffin of Citadel testifying in the congressional hearing after the GameStop episode on the role of wholesalers in this whole saga. And of course, he says that the wholesalers are wonderful. They are the ones that bring lots of benefits to investors in the form of tighter spreads. And these are your meme stocks here, GameStop, AMC, Bed Bath & Beyond. And as we will see, he does have a point that they do provide tighter spreads. They are, of course, lots of nuances in that. So to analyze the question, of course, we need data. And it turns out that for the US, we have pretty good data on this payment for order flow. The retail brokers are required by the SEC to file reports, the so-called Rule 606 reports on the routing of orders with the SEC. And since this is data filed with the SEC, I'd assume it's correct. And it's a pretty detailed data that you can extract quite a bit of information out of. So there is also a financial regulator, FINRA. And to FINRA, these wholesalers, internalizers, they have to report internalized volume in each name. The data is public, and we have downloaded it at some point. When you turn to Europe, this PFOF landscape is a lot more opaque. Like European markets to start with, yeah. For the US, you have the consolidated tape, both for equity trades and for option trades. For Europe, there are lots of segments of markets, as you know, in various countries, and even within countries, there is some segmentation. So this paper, Aramin and Carol Comerton Ford, they have a couple of papers, one so nice overview article and one new one about European retail trading in Europe. There are lots of nuances there. And one paper on PFOF that I recently came up with is for Germany by Peter Hoffman and Jank. And they use regulatory data. So maybe that's what we have to resort to for Europe. And from this regulatory data, of course, they know a huge amount of information. So they could infer, and Peter asked me to put an upper bound here just to hedge. So they infer the payment for order flow in the German market. I'll come back to that paper. So this is evidence for the US. And what I'm plotting here is the monthly payment for order flow in millions of dollars for options and for stocks. What we've done, we have gone over this payment for order flow form submitted to the SEC, and we just hand collected everything and aggregated them. So the blue line is for stocks and the red one is for options. And what jumps at you immediately is that the red line is higher. About 2/3 of the aggregate payment for order flow comes from options, not stocks. And in terms of the orders of magnitude, let's say what for the 2021, the GameStop year, 2.5 billion of the total payment for order flow came from options and 1.3 billion came from stocks. You may be wondering what these retail investors are doing in options. Why should retail investors be trading options? They shouldn't be, right? That's what we teach to our students. Unless they have something to hedge, they should not be trading options. But here you go. So there is a huge amount of, and I will show you the increase in the trading volume coming from retail investors in this asset class. So this market, if you look at wholesalers who execute these orders, is incredibly concentrated. So this information, again, is from the payment for order flow forms filed with the SEC. And what you see that for options, the share of the top 3 wholesalers is around 85% of the market, reaching 90% at some point. Who are these big three wholesalers? Well, the household name like Citadel, Susquehanna, and Wolverine. So if you look at the share of top 5, this is in the upper 90%. The market for equities is a bit less concentrated. And so there is an, still the numbers, you see the numbers of the vertical axis. Yeah, so this is 70%, this is 85%. So the share of top 3 is somewhere between 70 and 85%, still very high. But we will see an interesting episode here with the entry of the new wholesalers, and we can use that as an experiment to answer interesting research questions. So who are these top 3? Citadel, Virtue, and Susquehanna. And if you look at the share of top 5, it hovers around 90% of the market. Very concentrated indeed. How does this new system, well, PFOF is not really new, but I think what's new is zero commissions. And with the zero commissions, PFOF just flourished because this is where revenues of brokerages come from. So how does that affect execution quality? We now have quite a few papers saying that in equities, wholesalers do provide significant price improvement. And so this is not just one, but I have 2, 3, 4, 5 papers saying that. And I am sure that I have forgotten some that make the same point. If you ask Citadel or other wholesalers, you saw Ken Griffin on my slides. So wholesalers, brokers, and exchanges, they would agree with this assessment. Should we be surprised and should we be celebrating the fact that they are providing price improvement? I would say that we should not be surprised. So this price improvement is completely consistent with the cream skimming theory of Easley, Kiefer, and O'Hara. Look, think about it. We are segmenting the market. We're attracting retail investors who are uninformed investors. And we should be offering them tighter spreads because they are uninformed. These are our noise traders. And in fact, there is academic literature that now uses, I will show you proxies for these retail investors as a proxy for noise traders in testing their models. So they should be offered tighter spreads, and this is what we see. Do other investors for whose orders are not internalized, like institutional investors, do they see better bid-ask spreads? And the theory would say no, because now there is a lot more adverse selection in the broader market. Once you suck out the retail order flow out of it, it's all informed flow. So the spreads technically, theoretically, should be wider now in the broader market. So price improving over those even wider spreads is not particularly difficult. So that's the potential concern. And to be able to test that theory, one needs a structural model. So what happens with and without this order flow segmentation to infer whether it's really good or bad overall. An intriguing question is whether payment for order flow is related to price improvement. So let's think about it. You are a wholesaler, let's say Citadel, and you find the execution of retail orders profitable. I will show you some evidence. It certainly is profitable. And then you share part of these profits with brokerage in the form of the payment for order flow and with the retail investors in the form of price improvement. And one would think that there could be a trade-off between the two, right? There is a limited amount that you want to share, and you perhaps could be dividing it between payment for order flow to the brokerage and price improvement to investors. And many researchers in the area have been asking the question whether there is this trade-off and whether this is true, that brokerages that receive or charge higher payment for order flow generate less price improvement for investors. And one paper that started looking at this question, probably they were the first, is Schwartz, Barber, Huang, Jorin, and Odin, who have this very ingenious idea to run an experiment in the US, in the stock market. So they have opened accounts in many of these retail brokerages, and they're spending their own money to send trades, simultaneous trades for the same name from different brokerages, and to see the execution that they get from that same trade, depending on which brokerages it went out of and depending at which wholesaler executed the order. So it turns out that in the US, you can request from the brokerage the information how your particular order was executed. So which wholesaler it was sent to and the exact execution price from that wholesaler. So they do submit this request and receive this information. And they find the following. So a headline result is that there is a huge amount of heterogeneity in price improvement across brokers. So this is TD Ameritrade, Fidelity, E-Trade, Robinhood, and two types of the interactive brokers account. So the size of this heterogeneity is quite remarkable. Now, so they try to address a question whether payment for order flow, brokerages with higher payment for order flow provide better or worse price improvement. So their results are inconclusive. There are other papers, two other papers that run the very similar experiment. One is Levy, the other one is Gallen and Gallen, that try to get at that same questions. And I think in their papers, they do tend to gravitate towards higher payment for order flow means worse price improvement for investors, but the jury is out there. It's a very open research question. And I think this idea with an experiment is a very ingenious idea that people could use. So I think their paper was the first one. This experiment, they were adjusting it on the go a little bit. I think the new papers running this experiment should pre-register it and follow the rules of experimental economics of doing these things the way it's done in experimental economics and finance. But the idea is, I think, fantastic. And so they really can put their finger on what's going on there in terms of identification and in terms of causality. Why is it? My next question is whether internalization is profitable. And here I provide evidence from Hoffman and Zhang from Germany, from regulatory data. It's not available to all of us, unfortunately, but just to show that in Europe, this data is available. It's just a matter of working with a central bank to be able to get that data. And so the way payment for order flow is organized in Germany is that the retail broker works with just one wholesaler. So the wholesaler is a monopolist. So, and not surprisingly, they're finding that the retail market making is extremely profitable. They compute revenues of these retail market makers. And they also look at the variability, the volatility of that revenue. And their headline number that they want to report is the Sharpe ratio. So this revenue is not particularly volatile because the order flow is indeed quite balanced, quite symmetric, and there isn't really any price impact of these retail trades as you would expect given the informational content of this trade. So their headline number is that the Sharpe ratio of these retail market makers is 17.85. So it is indeed a very good business to be in. And to put this number into perspective, they compare this to the Sharpe ratios of earned by proprietary trading firms, and they find that this is more than 2 times as large. So given how profitable this business is, so it's not surprising that they could spare some money for the payment for order flow. And they do a back of the envelope calculation. They don't have regulatory data on this payment for order flow the way we have for the US, but they're saying that a market maker has a choice whether to become, to execute retail to the retail brokers in the term, in form of payment for order flow, to be indifferent between the two options. And they are saying that this willingness to pay is more than 60% of their revenue. In terms of the dollar amount, the payment for order flow, the size of that would be similar to what we get in the US. The German market is much smaller than the US market. So if you scale it proportionally to the size of the US market, the orders of magnitude are quite comparable. Now a bit about the order routing practices. And again, I will rely on this experiment from the US with the paper Huang, Juren, Li, and Schwartz, who again send these simultaneous trades via different brokers. And what they find is that first, these brokerages, this they didn't find. They knew that from conversation with industry participants, that brokerages uses this proportional and smart routing. What is proportional? You just send 1/3 to Citadel, 1/3 to Virtue, 1/3 to Susquehanna. And then there is this smart routing. Then depending on the characteristic of the order, you will send it to a specific wholesaler. So about 2/3 of what we see is proportional, 1/3 is this smart routing, what they report. And so even within a broker, interestingly, they see a large dispersion of execution costs, which is quite interesting. And you would think that in the perfectly competitive world, if they have a wholesaler with a particularly good price improvement, that wholesaler should be rewarded with more retail orders routed to them in the future. And this is not the case. So brokers do not seem to change their routing practices based on past execution. And another piece of evidence suggesting that this marketplace is not perfectly competitive is what happened following the entry of Jane Street, which is another wholesaler that entered that market in equities in the middle of their sample. And what they show is that this entry resulted in a significant price improvement, significant improvement of price execution by other wholesalers working with the same broker. So regulators have had their eye on that practice, of course, and are watching it very carefully. And in fact, they're moving quite swiftly. So the SEC made their first move in 2022, announcing their plans for significant reforms for in this payment for order flow practice. So these reforms have not been very popular with the industry participants. And so for now, this implementation is a developing story that we should watch. The industry have pushed back significantly against these proposals, but let's see what happens. So in Europe, we have some studies from the Dutch regulatory data, Spanish regulator, who found that this PFOF leads to worse prices. We know that PFOF is already banned because of the bad incentives it provides in the UK, Australia, and Canada. And in fact, the most recent, I'm not sure all of you know that the European Union has decided to ban payment for order flow in Europe from 2026 onwards. So that German brokerages are unwinding that, or should unwind it by 2026. Now let's talk about the new retail investors who are presumably the beneficiaries of this price improvement. So here a bit of the big picture. The first evidence that we have came from equities. And early on, Robinhood released a data set known as Robin Track. So it's a very nice data set. Unfortunately, at some point, they realized that once the researchers have jumped on this data set, that it's a bit too good. And so they have stopped providing it after 2020. But whoever managed to download, so they have this data from 2018 to 2020. And this data has been extensively analyzed in finance. So the first paper, it's the JF paper of Ivo Welch that looks at performance and stock choices of Robinhood investors. And the surprising conclusion there is that they have outperformed the market. So Robinhood investors have both good timing and good alpha. Of course, with a short sample like this, it's difficult to separate skill from luck. But at least they did not, I'm sure that he was expecting significant losses. And then the data came up showing actually gains. So Barbara Odin and the co-authors, so they analyzed this Robin Track further and point out that Robinhood investors engage in attention-induced trading. Was this attention-induced trading? Well, the stocks that are in the news, they attract attention and they pile up into the stocks, creating hoarding events or these meme stock episodes, GameStop, etc., that you have heard about. And following these hoarding events, the returns of these retail investors are definitely negative. There are more papers on this, but let me cite my PhD student who was on the market this year with a Robinhood paper. And she, among other things, she constructed a sentiment index out of Wall Street Bets posts, which is an investor forum popular with Robinhood investors. And many say is behind that meteoric rise of GameStop at the time. So not only she collects various words, she also collects emojis like the diamond hand and the rocket emoji, and this it goes part into her sentiment index. And so she shows that the sentiment indeed predicts net days increases in Robinhood investment. So this is Roaring Kitty, the famous trader who behind the GameStop saga, who is very listened to by other investors on this platform. So to summarize this, what are the distinguishing features of this new generation of retail investors? So they are like traditional investors in many respects, but three features stand out. So they are young and unexperienced. So in the Barbara Odin data set, the 18-year-olds were not picking up their phone to call the broker and place a trade. So these ones, they trade, they start young, trade off their smartphones. And there were no smartphones back then. They are very connected via various investment forums on social media. Stock tweets, fin tweets seeking alpha Wall Street bets are just some popular names. And what do these forums provide? Unlike in the past, here we have coordination between investors. And so the GameStop and the meme stocks episode This is clear evidence that they were coordinated. Otherwise, this GameStop would not have on the rocket gone to the moon. There are also echo chambers where they listen to some advice of some and not others. This social media provides. And there are many other aspects that one could analyze in the connection between the social media and investing behavior. Cooks and Mullins and Nisner have a very recent survey, what I think they call social finance, on this overlap between social media and investor behavior. And finally, last but not least, there is nudging. There were no smartphones back in the day when Barbara and Odin wrote their paper. And so those of you who have these apps, you can see the nudges that you receive from the apps. And we are all humans. Nudges matter. So we have a lot of colleagues who work on nudges. They do work. And especially if you target young and unexperienced investors, especially if you have some information about these investors and if you even know when to target them. So that could be an issue. And understanding this connection, I think, between nudging and investor behavior and stock returns is potentially interesting and new when it comes to this new generation of retail investors. Do these retail investors have an effect on financial markets? So Ethan, Green, Rosman, and Wu say yes, and Greg will be one of the discussants here. And so they have this very clever identification strategy, which many after them piggybacked on, including myself. They found that retail trading platforms sometimes have outages. And presumably, these outages are completely exogenous. So that just no trading for a number of minutes. And so they collect these outages at Robinhood and traditional retail brokers and contrast them. And the main finding is that the Robinhood investor participation increases market order imbalances, presumably because that flow is quite coordinated, think Roaring Kitty, decreases market liquidity, and increases return volatility. When you look at other brokerages, which E-Trade, others, which they classify more as traditional, Charles Schwab, there you seem to see the opposite effect. So there is even heterogeneity in retail investors across brokerages. There is also evidence in options that retail option trading increases the volatility of the underlying securities. And these are the two papers, Lipson, Tommy, and Zhang, and another paper by Ethan, Green, Rosman, and Wu. Now, I've seen some evidence from zero date to expiration options, which is a new retail craze that I will come back to. The evidence there is mixed. There are some papers saying that the volatility goes up and the papers saying that the volatility does not go up. So we have still to resolve that issue. Now about measurement. How do we detect retail trade in the data? And let me stress that this question is useful not only for behavioral finance, just to see how these investors trade. It could also be useful for testing some models in information economics, market microstructure, because these are the noise traders, and now you can see them potentially in the data. And so the first paper came from equities, and they, use the fact that this execution of these orders have changed with the advent of, with the entry of the wholesalers, etc., in the marketplace. So the paper that has been very influential in the literature is this one, Bomer, Jones, Zhang, and Zhang, published in the Journal of Finance 2021. They use TAC, which is the transaction level US data, for those of you who do not worked with it. And so it turns out that some of the trades are allowed to be executed with fractional pennies. You don't get an execution of, let's say, $1.52. You can have fraction of a pence for the price that you pay. And so those trades are retail. Institutional trades cannot receive this fractional penny of price improvement, but retail trades can. And they classify these trades with fractional pennies as retail. There are some other additional filters that they have to put, but that's the basic fundamental idea. And you can also classify which ones are buy and which ones are sell. If the retail buys are the ones that the transaction price is slightly below the round penny, and sells if it's slightly above the round penny. So this algorithm works quite well. There have been refinements, however, of that algorithm that have been proposed. And Barber, Huang, Jory, Odin, and Schwartz have a very recent paper forthcoming in the Journal of Finance that say that you have to impose some additional modifications to this algorithm to make it reduce the numbers of false positives, false negatives. But so this is where we are, and we can use the transaction level data in equities to classify these trades. We can also do it in options, and there have been work coming out in this space. I do it in a paper with Svetlana Brizgalova and Taisia Sikorskaya. So just like in equities, in options, there is a consolidated tape in the US called OPRAM. And from November 2019, this tape features new flags, execution flags, which are incredibly useful. And we have been using it in our research for a variety of things. And specifically, one can use these flags to try to identify trades that are retail. How does that work? In options, just like in equities, retail brokers, they need to provide some price improvement to retail investors. Now, in options, however, you cannot execute trades on your own private platform. All trades in the US in options must be executed on the exchanges. So you would say that there is no issue there. You bet. So this wholesaler found some loopholes of how they could effectively internalize trades in the bright daylight in the options market on exchanges in the US. And this mechanism is known as the price improvement auction. Specifically, we focus on these single leg price improvement auctions mechanisms. We call them slim trades. So this is how they work. So this is the retail investors sending an order to Robinhood. Robinhood routes the order to a wholesaler, for example, Citadel. Citadel cannot execute it internally. It will have to engage its affiliated market maker, let's say Citadel Securities, that will take the other side and will bring the already paired order to the options exchange and put it inside in an auction. So technically, other market makers can bid in that auction and provide an even better price improvement for that retail trade. However, the fees to participate in that auction, the so-called breakup fees, are so high that most of these auctions, they go uncontested. And the original market maker that took the trade to the exchange gets it. So you may ask, why are these breakup fees are so high? Well, exchanges, they also compete for order flow. There are 16 option exchanges in the US. They all want wholesalers to bring orders to them. And we spoke to these other market makers, and they do feel disadvantaged by the current practice of these auctions, but that's currently the way that is. And by the way, one of the SEC proposals of how to improve the market structure for equities is to, instead of it being executed by wholesalers on their internal platform, bring it to the exchange and enter it to an auction. Internalization in broad daylight on exchanges. So there is another way to internalize these orders, only small orders. It works for Chester Spath and Tom Ernst have a nice paper talking about this other form of internalization. So now I will talk about the evidence about the behavior of retail investors with a slightly deeper dive to my own paper with Svetlana and Taisia, what we learned once we classified these retail trades. So the first thing that we learned, so this retail volume, what we call slim volume, the one that went through the options to this price improvement mechanism, has gone up in our sample, which goes from the end of 2019 until the middle of 2021, gone up 101%. And you see that our measure picks up the June 2020 frenzy and, of course, the GameStop episode in early 2021. This increase is more or less in line with the increase in PFOF over the same time period, which is about 158%. So there is another measure that researchers have used before these new classifications became available, such as small trades up to 10 contracts. And this is also good. It's also increasing, as you can see, and picks up some of the same episodes, but it's more noisy. And we can see why when we look at the new flags. For example, some of these trades that are come in here are clearly institutional, because institutional investors, they might execute the big order not in full, but chop it up into pieces. So for example, trades like intermarket sweep orders or floor trades, there is no way retail investors could be placing those. They are sitting in that small trade measure. Just so you know, in case you are using that measure. Now, what kind of trades do retail investors place? Well, they definitely prefer call options over put options. They trade mostly at the money options. But what's most striking to us is that in our data, almost 50% of the trades are in these ultra short-term options with the expiration of less than a week. These options are not particularly cheap to trade. So the quoted spreads for the ones that they love, and actually also the spreads for the rest for average spreads in the market, is 12.6% quoted spread. Now, just to put things into perspective, a similar number for equities, well, let's say in the S&P 500, is less than 4 basis points. I remember when I was TA for an options class, I think in my PhD times, I thought I knew options market really well when I TA'd, and the butterfly spreads, the straddles, and on that, but nobody taught us that spreads are 10% plus. This is like a really serious number, isn't it? So yes, they do get price improved. Their effective spread is 6.6%, but this is still, a pretty significant number. Now, this was quite striking to us, and we were wondering why they go for these ultra short-term options. So one explanation could be that they're just gambling, so they are getting lottery tickets. In that case, it's kind of maybe innocuous. That's their preferences. We are not a nanny state. Let them be what they be. And another potential explanation is that these ultra short-term options are the default choice. on the retail trading apps when there's a whole, chain of options that you can trade on the given underlying, and the one that would show you as a default would be these ones. And we know about the importance of default choice from other works in finance. Default choice matters, and it matters a big time. So in that sense, it could act as a nudge, and you can see why this is not innocuous. Because if I nudge you into trading these short-term options, they expire a lot, then you have to buy another options, you trade a lot, and that generates a lot of payment for order flow for the broker and a lot of trading volume for the wholesaler. So in our work, we cannot separate these two motives, but it would be nice to be able to separate them. Now, in case my number wasn't very large on the previous slide, I wanted to write it a bit larger on this slide. So why are they trading so much? They are told that they are paying zero commissions, but zero commissions certainly do not mean zero trading costs. And I was going through the airport, I took a picture of a currency exchange booth in the airport, which is also zero commissions, but we certainly know that the bid-ask spreads in that currency booth are ridiculous. And so the ones in options are very similar. In the regression analysis, we also look at the preferences of retail investors. So they love attention-grabbing names, most traded and liquid, so they participate in frenzies. They prefer cheap or low price stocks because probably they are cash constrained. They love leverage. The average leverage for the short-term options that they buy is about 70 to 80. So they trade contracts with lottery-like features. And there is a lot of mass in those cheap micro trades up to $250. So why are they gambling in options? You may be questioning why, but okay, maybe it's cheaper than going to Las Vegas. So you just go to the options markets. And of course, all these proxies for retail activity we have, we correlate them with Wall Street bet mentions and other measures of retail trading, but the ultimate test comes from the outages, and we're very grateful for the outages idea that one can use for identification and validation of various measures. Now, performance. I guess you would not be surprised with our headline results, but let me first tell you how we deal with this performance. So we have all the trades that went through the auctions for the entire US market. Everything is very transparent there, but we do not know who is making those trades. So we need to make some assumptions. We assume that it's a representative agent, representative retail investor, and we need some assumptions on the horizon for how long that representative investor holds the position. So we go from intraday, 1 day, 10 day, and up to expiration. And and what we say that they buy at the actual price, meaning that they pay half the bid-ask spread when they get into the trade, but when they sell, we say that they sell at the mid-quote. So because sometimes they just hold it until expiration, and so in any event, so this would be conservative. So if you want them to pay half a bid-ask spread on the way out, then this underperformance would be even more striking. So let's say if you condition on the 10-day horizon, this number is in billions. We show that over a year and a half of our sample, retail investors lost $2.1 billion on their option trades. So these numbers already include transaction costs. So those bid-ask spreads, the currency booth in the airport. And so we can estimate, compute them very accurately here with our transaction level data using actual trading costs. So these costs are 6.4 billion. So kind of once you know that you have to pay this 6.4 billion, it's very difficult to fight against it and find any positive performance. No matter how great stock pickers they are, this 6.4 billion stone kind of pushes you down quite a bit. And so these indirect transaction costs, they exceed the direct transaction costs for the brokerages that still charge them for our sample quite significantly. Those commissions are under 1 billion. So this is where the real big bulk coming from. But once you see, so my headline number of 12.6% bid-ask spreads, you see where I'm coming from. And so interestingly enough, a lot of these losses, in the list of the 10 worst performing tickers that we have in our sample are GameStop and AMC Entertainment, contrary to the popular narratives. So we slice and dice this data in a variety of ways. We compute also returns in percent, which requires additional assumptions. But the answer is the same. So underperformance, and specifically in these short-term options, most of the underperformance comes from these ultra short-term options that the investors love. And a little bit more explanation we can get by looking at the trade direction. And what you can see, so most of the losses concentrate in these ultra short-term options, the ones that they buy, both calls and puts. Turns out that if they sell options on meme stocks, etc., these short-term options to the retail investors who buy, those are the ones who gain even after this massive trading cost that they pay. So that's the result, writers of short-term options. Yeah, so the ones who buy lose, the ones who write make even after transaction costs. Now there has been, so this is a great area of research that I encourage you to get into. There is very little work on investor behavior in options. There is some earlier evidence, one from a European brokerage, and this Lakonia, Lee, Pearson, Poteshman paper. Believe it or not, in the Barber and Odin data, there are options. There are not many, but they are options. So, and they are analyzed at Barber and Odin data. And I should mention the Dimas paper here, which will be presented tomorrow, which is on the very recent data that they managed to get from a account level data, which is great, something we do not have in our paper. We do not know exactly at the account level which trade was placed and then the trade was closed. And so they have a popular trading journal provider, and they find that option trades account for nearly half of the trades in 2022. This is a really significant proportion of the market if one were to generalize this sample to the whole market. And these days, investors moved primarily to the 0 day to expiration options. In our sample, they did not exist yet. And that was a financial innovation, and it looks like retail investors, this is where they moved. So in contrast to our work, so their trading losses, they show are relatively small. We'll fight it over as the literature settles. All right. Now I'm about to finish. Let me give you a couple of slides beyond options. And so interestingly enough, these new retail investors, as the literature finds, they no longer favor lottery stocks. And in the Barber Odin data, they did. Why don't they? Well, it looks like why trade stocks with lottery features when you can trade options, when you can trade crypto, when you can trade all these other asset classes. And this is a paper from Kogan, Makarov, Nisner, and Shore using data from eToro, which is forthcoming in the JFE. And so it's basically about crypto. This, what is it? The green sliver is here. is crypto, and other asset classes like commodities, you can see currencies, they're all thriving. And if anything, the investments in equities is shrinking, potentially indicating these gambling preferences. And let me maybe skip this slide. There is a literature on substitution between lotteries and retail trading. And now we have quite a conclusive evidence that some investors are really viewing the two as substitute. All right, and so let me maybe not give you the takeaways, but conclude with this slide that recently the roaring kitty has reappeared. So after he was in that congressional hearing together with Citadel's Ken Griffin about GameStop, he kept his incredibly low profile and hasn't posted anything. But just recently, 13th of May, he made his first post. And guess what happened? GameStop was up 74% following that first post of Roaring Kitty on his account. So this seems to be a developing story. And let me end here and take your questions.
Thank you very much, Anna.